Guys, welcome back to the Independent Investor Channel. My name is Ryan. It's good to be with you guys. I'm going to be offering a response to a couple of my very loyal subscribers that I've got through the community of self-directed investors who hit me up and asked me to do a series of folks that are in their 50s, 60s, or maybe even in their 70s looking to get involved in the stock market. And I think you guys can really appreciate my opinion on this topic. I'm so glad, I'm honored actually, that they reached out to me and asked me to do this. I immediately responded and will be taking on this project with a catalog of videos coming out addressing a couple specific suggestions of me, some specific scenarios to kind of help you guys, because I know there's a lot of people out there in the community. I'm old enough to gain whatever respect. I don't care what your age is. I know what I'm talking about. I've been doing this a long time. With that said, I do premise a lot of my videos with investing in the stock market. There is no guarantees at all. There really isn't. But I really want to take this topic for action for you guys. A couple of my subscribers, I know Lori's one of them, and then one of my subscribers hit me up on the live feed and asked to reach out to me directly and actually asked me to do this video for him as well. And I'm glad to do it. I'm actually honored to do it because you know, our community of folks that are 50, 60, looking to retire, approaching retirement, you know, hoping to enter into retirement and have a little bit of freedom and flexibility to enjoy themselves in the, you know, in the retirement, and they've earned that right. You know, maybe they've worked a career of 20, 30, 40 years. And when they do hang it up, they want to have, you know, something put away so that they can enjoy their retirement. And I take this very seriously. I have so much respect for our community that are approaching retirement, and I'm glad to help, guys, so please enjoy. If you guys are subscribers to the channel and you're tuning in and you're of a younger viewer, certainly you're welcome to stick around, but this is really going to be geared toward my 50s, 60s, and my 70-year-old investors, and it's going to be a little bit more long, and I'm going to take my time and really try to explain each of these topics. But before we begin, I'd like to invite anybody that's new to the channel. Maybe you are in your 50s and 60s and I've perked your curiosity. I know there's some folks out there that have come across my channel over YouTube and have felt so inclined to reach out to me directly. I encourage you to do the same. You're not going to get the maximum benefit out of this message without subscribing to the channel, so please do so. If you guys are also on Facebook, I highly recommend that you kick over to the Facebook group, because a lot of the success that we're going to find for investing in our 50s, 60s, and 70s is going to depend. And it's going to depend on what you've built up over your life, if anything, okay? And I need to understand from a holistic perspective where we're coming from before we look at specific options on where you can specifically go. Before I get started in this video, and again, I'm probably going to come out with a 5-part series on investing in your 50s, 60s, and 70s. I'm going to address some specific topics that was asked of me. But before we begin, I'd really like to discuss some ground rules, some things that I've had reciprocated to me through helping a lot of investors who have reached out to me, who are in their 50s and 60s, and they've really just kind of leveled themselves to me and asked for my help. I'm glad to do it. But there's a few unnecessary things that come back to me when somebody's asking for help, all right? And the ground rule number 1 I would like to put out there for anybody that's tuned in and really looking to get engaged and maybe invest a little bit more into the stock market, you don't need to apologize to me, okay? If you've waited your entire life and you've stayed out of the stock market for whatever validations that you've had, or perhaps maybe you've had somebody get involved in the stock market and gone through a severe downturn, and you've used those as reasons as to not participate in the stock market, you don't need to apologize to me or anybody else, okay? There is no perfect life, okay? There's just life, all right? And if you're looking at your current situation and you're 50 and 60 and you're saying, you know what, I'm getting closer to retirement, I'd really like to take on this program that Ryan talks about from a self-directed perspective. All right, and that is going to be the root and the backbone and the very foundation that we still start from, because I don't care if you're 18 or if you're 63. I could care less about your age. It applies just as much to the 18-year-old as it does to the 63-year-old. The sheer fact of the matter is the 63-year-old is not going to get to enjoy the compounding interest effect, and everybody can agree on that. We understand that fact. That's not why we're looking to invest and maybe set up another investment account to help us even more down the line to provide some expendable cash. So I need you guys to agree to this. Stop with the self-deprecating, apologetic, because I get it. Every single person I talk to, every single person that I talk to says, I'm so stupid. I waited to invest way too long in my life, and now I'm trying to make up for what I'm doing, and I can't sleep at night. These are some of the things that I've been hit with. It's very difficult for me to be hit with that because emotion has no place in investing, okay? If you want to enter into the stock market, I encourage you guys to get involved in the stock market for all the right reasons, and they are out there. And I will do my very best to exploit those, provide you guys the very best options going forward, all right? But no self-deprecating ideas, no apologies to me, please. That's rule number one. Number two is to have fair expectations. You need to identify still at 63 or 73, what are my goals in the stock market? What do I want to accomplish? Do I want to enter into some blue chips, maybe to pass a legacy on to my family, or maybe it's to invest and top up an existing account for 10 years? You really need to understand why it is you're looking to invest in the stock market. And I don't care, again, if you're in your 50s, 60s, and 70s and you're looking to invest in the stock market. As long as you have a defined goal and fair expectations about those goals, okay? If you come to me and you ask me, look, I need to make up for 30 years of not investing, please, Ryan, provide me a portfolio that's going to return a greater than average return of the stock market, I'm going to tell you I can't help you, okay? And I can't, all right? I'm just giving you the honest truth of the matter. You have to have fair expectations about what you want out of the stock market. Can we invest in the correct account? You bet we can. Can we invest in good quality assets that are going to grow for yourself over time, perhaps pay you a nice dividend year over year? You bet we can. Can we fund that to our control? Yes, we can. We can do all those things. But make sure that you have fair expectations about what you want out of a self-directed program, all right? Because I am not a magician, all right? And there are no financial planners out there that can put somebody into a magic portfolio and have them consistently outpace the market. It's untrue, it's not possible, and quite frankly, anybody who tells you that they can do it are full of crap, all right? So fair expectations in entering into a program, if you're out there and you're interested in your 50s, 60s, 70s, about maybe kind of perusing a few of the options that you have out there. What type of account would you like? What brokerage account are we looking at? And then what type of options do we have within that self-directed account, okay? Number three, if you're in your 50s and 60s and 70s, I need to have kind of an idea about how willing you are to subject yourself to a little bit more of an aggressive funding, because everybody comes from a different place in approaching me and saying, Ryan, I'm 50, 60. I never invested, but I'm sitting on, $750,000 put in the bank and I never invested. Is there a portfolio for me? Sure there is. If you haven't invested in the stock market and you've got $10,000 saved up in the bank, maybe you've got an existing 401k, that's fine too. It's just that wherever your position is coming from and you're looking to get involved in the stock market a little bit later on in life, you need to be a little bit more aggressive with your funding schedule, okay? If you were 20 years old, I tell people to get started with, $25 a month. That will work because they've got time on their hands in taking advantage of the compounding effect. If you don't have time on your hand, the counterbalance to that approach is to overfund the account. And for a lot of my folks in their 50s, 60s, they deserve the respect of me to sit across from the table and acknowledge that you guys are making making really good income. But for some reason or another, you haven't invested in the stock market. So if income really isn't a problem for you, and you're making a good solid income, and you've got a good solid budget that's defined, and you know how much accessible cash, I may be coming back to you guys and saying, look, 25 bucks is not gonna cut it, okay? Again, revisit goal number 1, all right? Goal number 2, have fair expectations about this program. If you're really serious about, investing on a schedule, look at a few $100s a month. That's really gonna be the end all and the start. Now, anybody over 50 is allowed $6,500. We're gonna look to exploit that additional $1,000 that you're allowed to contribute to a Roth IRA. We're also going to exploit your ability to contribute to a Roth IRA at any time in your life, okay? There is no age limit. As long as there are contributions that are eligible for funding a Roth IRA, we're good to fund that all the way throughout your life. There is no age discrepancy there. So if you're starting at 50 and you ended up on an aggressive funding schedule at $6,500 a year, when you're 61, you could have $65,000 in that account, assuming that you get zero appreciation out of those accounts. And that's not how we build them out. We build them out with cornerstones, high dividend paying, growth and value stocks, because the importance of wealth preservation when you're 50, 60, 70 is paramount, all right? It is absolutely imperative that we are not seeking overly aggressive stock in this portfolio unless certain conditions exist that would justify that type of positioning in a self-directed account, okay? So keep in mind that if an aggressive funding schedule is going to be appropriate for you guys, I have a couple that is looking to aggressively fund their accounts, looking at a couple $1,000s a month, and they can do it. It's just that they needed kind of the nuts and bolts of the A, B's, and C's on what it would mean, how it would look, where they could go in their future. And those are all questions that I can answer for you guys, so you can kind of say, well, we're not blindly throwing money at the stock market without any real defined goal of what it could mean in the future, right? Because if we start to set investment capital on a path, okay, and it starts to behave like investment capital, and you haven't invested for 50 years, you don't have that mental fortitude. You don't have that mental conditioning of having maybe a defined tolerance. Maybe you think you're a risk level 7, and you start to see your money fluctuate, and you're like, wow, my goodness, what was Ryan talking about? This wasn't in the deal. It is in the deal. That's exactly what investment capital is supposed to do. That's why the benefit of starting a percentage of allocation to investment capital that is strategically in line with what you feel comfortable with at your age, 50, 60, 70, is going to be appropriate over here with the correct allocation of cash buffer over here. So that's going to be very, very important for us to find a counterbalance of how much you could aggressively fund up in the schedule and how much maybe that we've got in accessible cash to make sure that that accessible cash is providing you the liquid benefit of accessible cash. It's not going to move. It's going to be static in nature, all right? But the investment capital is going to be allowed to do what it needs to do without getting involved in the program, and 2 months down the line, the stock market takes a heavy correction back 30, 40%, and we're stuck over here overexposed to the stock market. We do not want to see that in our 50s, 60s, and 70s, all right? Number 4 is you're going to make sure that your fitness for investing is at a high level, okay? And I name it fitness for investing, and that's assuming that a lot of the intangibles are in place for you guys. If you're sitting across and you're listening to this message and maybe you're taking notes and you're trying to take some really good takeaways from the video, I really need to make sure that you are reassessing where you guys are in your fitness to invest. What do I mean by that? What I mean is I need to have debt under control, okay? We are not going to set ourselves up on an investing path if the debt is out of control. There's nothing that I can do over here to counterbalance poor or decisions that you had to make. Maybe you had to enter into debt by no choice of your own, and it's not your fault, but there's no investing capital that I can put into the market to magically counterbalance a debt load over here. It's basically investing in a vacuum, and it's not something that I advocate for. So we need to make sure that the debt is under control. And if I'm speaking to somebody that's 50, 60, 70, I would absolutely make that a criteria and assume that those things are under control. But it's definitely worth speaking about. I also need to make sure that your fitness for investing is prepared in a manner that you have some savings built up, okay? If you have an unexpected emergency, are things going to be able to be paid in your stead? Do you have deductible money put away? Okay, we're going to get to some of that stuff, but these are some of the things that you have to understand. If we can't take of some of those fundamental portfolio building strategies in debt reduction and savings amount on the sideline here, it doesn't do us any good to pursue an avenue of investing and dedicating any amount of dollars to the stock market, which are vulnerable to fluctuation, okay? So it's very, very important that by going through each of these goals, it's really gonna help you take a step back. If you take a step back and you're in your 50s, 60s, and 70s and you're watching this video and you expected me to put out some sort of magic solution for you guys, and you sit back and say, gosh, Ryan really talked about goal numbers 1, 2, 3, and 4, some ground rules. I don't know if I'm fit to invest. And that can be just fine. If you sit back and you say, you know what, I hear what Ryan's talking about. He's really trying to put out a defensive message, okay? And I would be giving that defensive message whether or not we were in a bull market or a bear market, okay? It doesn't matter. What you need to assess is to make sure that you have a defined goal. And I'm assuming that since you guys have reached up to me, that you guys have those preliminary steps in place and you're ready to rock and roll. And if you are ready to rock and roll, I'm ready to rock and roll with you, okay? But it is unfair of me to say that we can just take absolutely everybody and put them on a track to success if this investing thing just doesn't quite fit with you, okay? So you need to be fair to yourself and give yourself an honest answer with regard to how fit you are to enter into the stock market. And if you need to fix a few things, we can do that. If the cars are paid off, if the cars aren't paid off, but we can pay it off in a year and a half or 2 years or 3 years, certainly we can look at those cash debts now, look to get those off of the budget, and then that's going to free up more cash flow. And it may be more of an appropriate time to understand down the line that those dollars within the inflows are going to be freed up in the budget, therefore allowing more capital to be devoted to a stock portfolio. And you may look at me and say, I'm good to go now. I do acknowledge these pieces over here that in due time are going to fall off the table, and that's going to give me that much more fitness to go ahead and feel comfortable entering into a stock program now, or a stock portfolio, or an investing portfolio now at your age, okay, depending on what your age is, all right? The last thing that I kind of want to talk about, and I pulse these requirements to you guys, are ground rules anyway. I want to make sure that they're well defined, because these are the things that I end up asking of my community when they reach back to me. And I've had a lot of people in their 50s, 60s, 70s reach out to me for a lot of different reasons, all right? Everybody's coming from a different place. But for me to be able to take a holistic approach to giving you guys the best information that I can for you as individuals, you really need to sit down and look at your entire landscape of what you bring to the table, okay? Assets, all right? If you have an existing 401k with $50,000 in it, wonderful. If you have a 401k with $10,000, if you have a 403b, if you have a 457, if you have a SEP, anything in place in way of savings, existing retirement accounts, I'm assuming that debt is eliminated, so we're working on the right side of zero to try to achieve that positive interest rate. But I want to make sure that the existing accounts are at least disclosed, okay? And you can disclose them for yourself. You don't need to disclose them to me. What I'm doing is providing you guys the fifth ground rule in identifying certain assets that maybe you've built up over time, that maybe you've built up over time and you haven't paid too much attention. I know one of the subscribers, Lori, just hit me up this morning, and she said, you know, she's paid attention to her 401k very little, and it's kind of performed not up to her expectations. However, since it is existing and the decision was made to enter into a 401k at some point, it's probably done its job and it's probably got a little bit of net worth in there, all right? And even if it's got $20, $25, $30,000 in that account, maybe it's a $10,000, we're still going to use that information to further build out our self-directed account, okay? And I'm assuming that for a lot of you guys, this is gonna be your ticket. It really is, all right? It's going to be kind of an icing on the cake, all right? It's going to be the tip of the iceberg. It's going to be the top of the pyramid, all right? Because you guys have some sort of established fundamental base in line, and that way you can work with me on establishing that top position in there and get some really good single stock portfolio building tools in there, okay? And the last thing that I want to kind of add is if you're in your 50s and 60s, 70s, kind of along that, making sure that your fitness is square, or do you have multiple retirement accounts? Another thing in working with you guys going forward, I really need to understand if there is a spouse involved, and I am extremely aggressive on involving both parties, okay? Do not expect me to work with one spouse and leave another spouse out in the dust. I will not do that. Don't ask me to do it. I've been asked to do it before, and I kindly decline. I will not do that. I don't initiate my program that way. It's just going to set yourself up for animosity going forward. It's planned failure going forward if you can't do this together. Now, it doesn't mean that your funding sources need to be the same at all. It absolutely doesn't. What I'm saying is, if you guys are looking to coordinate your efforts together, you need to make your decisions together as well. And I cannot stress the importance of this enough, all right? Because I will build a holistic portfolio that respects both parties, both spouses, that bring whatever strengths or weaknesses to the table. And that is extremely important. I cannot build a strong portfolio for one spouse to make up for the deficiencies of another. I cannot do that, all right? Those are some of the ground rules, and I've spent 20 minutes just talking about the ground rules. But again, in this catalog of video, I hope that you guys find so much value in really talking about the meat and potatoes of building out this portfolio. I want to stress again, if you're tuning into this channel, you found your way to the channel, you guys need to link over to the Facebook group and basically just let me know that you're part of the Investing in Your 60s series, all right? Just say, look, I'm part of the investing series. I watched the first introductory video, and that way I can kind of keep tabs on those individual threads, and we can build those threads out as individuals. That's kind of the way I see this going. Now, it's going to be visible to my group. It doesn't matter. You guys don't need to disclose a whole lot of information in there. The more descriptive you are with me, the better. The better plan that I can initiate, because I told a couple of some of my favorite subscribers, and I just love these kids to death. They're just fantastic. I told them, I said, you know, building the portfolio is the fun part for me, and quite frankly, it's the easy part. It's the hard part for most people. It's the easy part for me. The hard part for me, and the reason why I've spent 23 minutes on the baseline, fundamental, philosophical lessons in the stock market, is I do not want to build you a solid portfolio, because you can take that without the proper psychological knowledge and screw it up. You really can, all right? Because you're going to be on your own as far as taking this program, but if I have not prepared you to understand or foresee certain things that are inevitable in the stock market, you will falter. You really will. You'll falter. And by starting in your 50s and 60s and 70s, I want each and every one of you to acknowledge, I'm starting late and I don't care. I'm going to embrace this challenge and I'm going to make it the best that I can. That's just what you have to do. And that's what a lot of 18, 19, 20-year-olds don't have, because they don't have the life experience of an understanding how important that is to take charge of a new challenge in your life, all right? I was hit up with the question, I'm 60, what can I invest in, all right? We're going to kick this series off, and I'm going to try to keep these to a half hour if I can in delivering this to my group. But I want you guys to really internalize this information. If I've missed the mark on some of these, I expect the community to come back and offer those comments to me in the commentary section of each of these deliveries, all right? Because you guys are getting my A+ effort here. You're getting my very best information that I can provide to you guys. If I was in your shoes, I would want somebody in my 40s like myself providing this very information to me. All right. So I'm 60. What can I invest in? It really depends. Okay. And I hate to give you an open-ended answer, but let me explain. It really depends on the cash that you have on the side. Okay? It really depends on your debt situation. If you're carrying an exuberant amount of debt, I kind of talked about this a little bit, we really need to get this under control. We really do. All right? And if you are sitting on a good amount of cash, I've had people in their 60s reach out to me and they're sitting on $500,000 and they just want to know how they can put a strategic stock portfolio together. No problem. If you're sitting on $10,000, then we need to allocate that money in a strategic manner, not to overexpose to the stock market, to be reflective of the assets that you currently have, irregardless of what your age is. Okay? So just kind of keep that in mind. What can you invest in? It really depends on your cash situation and your debt situation. Okay? Now, another aspect to it depending is your level of life insurance. Okay? In your untimely passing, are you going to put your spouse, and this goes both ways, in a peculiar position, okay? If you don't have any existing life insurance, okay, what good does it do to invest in the stock market if upon your untimely death they can't use that or they can't survive? If there's not enough cash or too much debt, right? If there's not enough insurance in place to supplement that way of life. And I'm not talking about an exuberant way of life. I'm talking about making sure that the current lifestyle can be upheld. And that's something you really need to understand. Is there an appropriate level of life insurance in place to ensure that your spouse, either one, in the untimely death of either yourself or your spouse, are going to be taken care of? And it's absolutely imperative that you answer this question for yourself if you're looking to get invested in the stock market. And I just want to make sure that you guys are prepared, especially if there are dependents involved in way of smaller children, college-age children, if there's college tuitions that are being paid out through the family inflows and you're the sole source of that income, you need to take that into consideration before entering into a stock portfolio, whether or not those assets would be better being devoted to another place, to make sure that in your untimely passing you can make sure to at least maintain that level of lifestyle, make sure that it's not going to be a jarring removal of that inflow of income. All right. I'm 60, what can I invest in? So I've built up to this first installment of this Investing in Your 60s videos really to get to this for you guys. And I really look forward to working with each and every one of you guys. The reason why I set all these ground rules and I really try to talk to you guys. Make no mistake, I'm not trying to talk down to you at all. I'm trying to talk to you. But I say this all the time, it's going to be imperative that we talk with each other. Okay? I have to know these certain things before we start identifying the portfolio building piece. And that's the easy part. If you guys are interested in investing in the stock market, I want you to really think about some of the things that I've talked about with having realistic expectations. I want you to really define your goals, identify maybe if investing is even for you. If you're carrying a higher than average debt load, certainly that needs to be reduced over time. Identifying if you've got too much cash on hand and that's being chewed up by the impact of inflation over time, I can understand why you're excited about investing, and I'm just the guy to help you. That's totally fine. I don't mind doing it, but make sure you're doing it for all the right reasons, all right? So what can you invest in your 60s, 70s, whatever it may be? First of all, we're going to house whatever assets that we get into the Roth IRA. All right, it's still eligible for contributions. We're going to take advantage of the catch-up contributions, definitely through your 50s. So if in your low 50s, you definitely want to get that account started, and you can actually begin funding that on a $6,500 maximum per year. All right, so you need to kind of look at whether or not you're comfortable with a monthly allocation to that account, and you're going to want to start that off. If you've got the $6,500 in your bank account and you're sitting on $50,000, $60,000 cash, and you're satisfied with that level of cash reserves in your savings, you could go ahead and max fund that account and we can get rolling right away. I've already had a couple people do that, and they're excited to do that. They're having trouble sleeping because they're so excited, and I don't blame them, quite frankly. But that's kind of where we want to get you to. Once we get that account started, we can really start to look at what is going to be appropriate for you. Now remember, I talked about whether or not if there's one or two of you involved, if we can max fund Roths, self-directed Roth IRA accounts for both of you guys, of course we can double up that funding schedule. Okay, so we're looking at double the amount in that account. I mean, we're looking at $13,000 instead of the normal funding schedule for anybody that's less than 50. So if we can double up on that and you have the inflows to do that, and you're sitting on, you know, $50, $60, $70, $80, $100,000, and you're looking to start these accounts, we can channel those max fundings into both of those self-directed accounts, okay? And that's really why you need to look at this as maybe a dual effort if you are in a spousal situation. If you're single, no problem. We can start it as a single person, max fund that account up at $6,500, or take $6,500 and divide it by 12 and look at what the max funding schedule would look like. It doesn't require you to do a max fund, but you'll have an idea of what we're aiming for. Remember, to be part of that aggressive funding as part of the ground rules that I talked about, because that's what it's going to take really to kind of interject and kind of manufacture that compounding effect and interject in the compounding matrix, right, as if we had been investing for years. We want to max contribute that account up. Once we get the account started and you've acknowledged all the ground rules in that account, you're knocking on the door, okay? You're right there ready to go ahead and deploy your capital into the self-directed account in the form of either single stock or ETF investing. For my crowd of 50s, 60s, and 70s, we will not deviate from good blue chip companies. If you guys are interested in some growth names, I have no problem with recommending a Google to anybody. I don't care what their age is. I don't care about investing somebody in a Facebook, but it has to be correct. It has to be right. I'm not going to carbon copy and say that the Facebook is an investment that is appropriate for everybody, okay? It has to depend on the holistic picture that I talked about earlier on in the delivery, and it has to fit in the portfolio. It's the same thing I premise every single time when I talk single stock picks, to make sure that those single stock picks are appropriate for every investor. It may not be appropriate for everybody to invest in Walmart. Now that's going to be one of my flagship companies to participate in because it pays a wonderful dividend and it's a well-established company. So it fits in respect to trying to preserve that money into your golden years, 50s, 60s, 70s, and beyond, right, as we enjoy being an investor, okay? So it's really going to be up to you. The question was posed to me, if I'm in my 60s, what can I invest in? I'm not one of those limiting investors, no way. I want you guys to be able to, if you want to invest in John Deere, you're going to hit me up and I'm going to tell you to invest in John Deere. It's really just that simple. I say this all the time. Sometimes the very, very best investments are right in front of your face. And if you guys hit me up and say, God, I've seen this Johnson & Johnson my whole life. Should I invest in the company? Absolutely, you should. You know, I take my kids or my grandkids to Disney every year. Should I invest in Disney? The answer is going to be yes for you. But we're going to look strategically in each and every one of those names. And trust me, guys, it's going to be fun. I just want to close this video and kind of encourage you guys and thank you for bringing this topic to my attention. I'm going to work my tail off on this particular block of section. I expect no payment out of this whatsoever. The appreciation that I get for putting out a catalog of videos for investing in your 60s, hit me up with a thank you. Be open and honest with the information, because the recommendations that I make, or the opinions that I give you guys on how we can potentially build this portfolio out, is going to be based on the strength and reciprocation of the information you provide to me. All right, so it's going to be very, very important. And I will end on this note. I really, really want you to be excited. All right, every single person that's approached me and asking me, and humbly asking me for information, has always come with a self-deprecating idea. And they've always said, I can't do it, Ryan, or I've got to invest to make up for all this investing. And by the end of the conversation, they're excited, right? They have a defined idea of what they want out of their plan, and they're excited about the prospects of the future, and they're making moves to make sure that they're validating for themselves why it is that they're doing. Guys, thank you so much for tuning into this very first installment of Investing in Your 60s. We wanted to get some fundamental principles out of the way during the delivery of this message. If you know anybody out there amongst your community, and you know folks, friends, family, etc., that are in their 50s and 60s and 70s, let them know that I'm going to be coming out with this message, and I'm doing it as a gift. It's a give back to all the people that I feel like this country should have the utmost respect for, who have worked hard: blue-collar workers, teachers, doctors, folks that have come up through the ranks, legal professors, everybody who's come up through the ranks and put in a hard-working career. It's the least I can do to show my appreciation to you guys if you've gone through your life and the stock market has not been part of your life. Let's see if we can't introduce a piece of the stock market in your life going forward. I'm here to help you. Guys, thank you so much. Leave your comments in the commentary. Share this message out there with anybody amongst your community that can benefit from this information that hasn't invested in the stock market. Let them know. Let them know that I've come out with this channel. I'm just over a year old, and I think the sky's the limit for this channel. I really do, because I believe wholeheartedly in the message. I believe wholeheartedly that it's not quite as big and bad, as scary as a place that people make it out to be. And I absolutely believe, irregardless of your age, whether 18 or 65, you absolutely have to participate in the U.S. stock market. And that's exactly what we're getting people to believe in. Guys, thank you so much for tuning in, and good luck in your investment future.